the housing bubble different this time? Are we going to see a repeat of 2008? We're going to take a look at this article here on Zero Hedge that states it is much more precarious. We're going to go over some of the similarities that we saw as well as what might unfold here in the future. So stick around, you're going to want to hear this. The article first talks about speculative bubbles. So all speculative bubbles share certain traits. First and foremost, it's the abandonment of caution. Euphoria is saying that there will be seemingly endless gains. In other words, something is going to continue to go up in price forever. And the eventual reconnect with reality is when the bubble pops, and then you see the symmetry as the waterfall decline mirrors the euphoric ascent. At the same time, the specific origin and nature of each bubble is unique to its era and its circumstance. So what we saw play out in 2008 with that housing market crash or the great financial crisis, that of course was the result of the vast expansion of the subprime mortgage lending, which of course the initial goal was actually just expanding home ownership to the lower and middle class by lowering credit standards. We're actually seeing some of this play out today where we're seeing a little bit more lenient guidelines with higher debt to income ratios or loan level pricing adjustments. And what happened in the past is when they loosened up these guidelines, we started to see things like no documentation loans, also known as liar loans. We saw negative amortization mortgages or pick-a-pays where you had several different options. You could literally pay a 30-year fixed, a 15-year fixed, an interest only, or you could actually pay a less than interest only. They called it the negative amortization option, where it would defer the interest and literally add that to the end of your loan balance. And of course, they had interest only loans and adjustable rate mortgages as well. And all of that basically led to the rise of defaults in the mortgage-backed securities, which ultimately led to the housing market crashing back in 2008. Now, to the author's point here, the rock that starts the landslide does not have to be all that large. If you take the entire subprime mortgage sector was a relatively modest percentage of the mortgage market and a tiny slice of the global financial system. But it is the nature of bubbles to be a pyramid house of cards in which the entire bubble is based on debt expanding and supposedly solid foundation of rapidly rising collateral. For instance, home prices continuing to rise. And the example that he gives here is that the McMansion that sold for $300,000 a few months ago has doubled in value, and now it supports a mortgage that is $500,000. He goes on to say that the delighted spectator takes the quote-unquote free money, $200,000, and buys another McMansion. So in other words, the house that they had purchased for $300,000 that doubled in value, they refinance, pull out another $200,000, buy another house, which is basically adding to the overall debt and then helping them build a mini empire of homes, all of which is gaining value as the bubble expands. He refers to this as a virtuous feedback, which expands the housing valuations, collateral, and the debt that is deployed to buy more homes. In other words, it's all fun and games when the assets are rising, the debt is cheap, and it's easy to get because you can continue to go out and buy more homes and build out a portfolio. But then what happens when the feedback loop actually reverses? Well, once the bubble pops, valuations decline, collateral diminishes, and eventually all mortgages are underwater. This is what we saw play out in 2008. And once the mortgages are underwater, it is no longer supported by the collateral because we would owe more than the property is actually worth. Now, at the same time, income generated by those assets actually would decline as well, or most likely would decline, which makes it difficult for the owner to actually service the debt. So the pushback that I would make on this particular argument is that the owners and people who were buying these homes were buying them fueled by speculation. They were simply hoping that whatever they paid for it today would go up in value tomorrow. And the operating costs of the property were not supported at the time of purchase by the rental rate that that property could actually generate. And so once the value started to come down, put them in a position where even turning these into rentals at current market rents would not even come close to being able to service that debt. So they have a negative carry. And if you're in a position where you have, let's say, 10 houses with a negative carry, how feasible is that to actually service that debt? You know, maybe 1 or 2 houses with a couple $100 negative carry. But when you get to 4, 5, 6, 7, 10 plus, and you're having to carry $500 negative on each of those properties, it becomes very, very expensive and hard to manage. Now, the author goes on to say that this time around, the source of the bubble isn't the subprime buyers. It's actually wealthy investors and corporations using excess savings and easy credit to snap up homes and rental apartments as safe places to park their excess. So now the question is, why is real estate a favored place to park excess capital? Well, they give 3 reasons here. Number 1, as a general rule, it's a stable, lucrative source of income via rents. So in other words, an investor can park their capital and they can earn a yield on that money while they wait for the property to go up in value. Number two, real estate typically has a lower risk profile than assets such as stocks. And one of the reasons that is because real estate provides shelter. It's a place to live. Everybody needs it, especially if you're looking at the quote unquote starter home or apartment buildings. You know, everybody needs that 1 bed, 1 bath, or that 2 bed, 1 bath, or that 3 bed, 2 bath, single family house that's 1,200 square feet. That's going to appeal to maybe 80% of the tenant pool. It's something that's in high demand. It's not going away anytime soon. And then number three, in the eras of expanding credit, leverage, and population, real estate typically increases in value as supply is inherently limited by geography and other factors. And then the other thing that I really want to add here is that the wealthiest investors and large corporations generally will have access to really cheap debt as well. Now, they provided this chart here, which I thought was really interesting here because it talks about there not being a shortage of housing. The population and the number of employees 18 to 64 years of age in the American West remained essentially flat, while the number of housing units increased by 1.3 million. And yet there's supposedly a sudden shortage of housing for rent or for sale. So if you take a look at this chart here, this is the number of adults ages 18 to 64, which has been flat for several years here. It's gone up, modestly over the last 23 years. And then you see the number of employees, which has gone up modestly over the last couple decades as well. But we're still at about 37.9 according to this chart. And I'm assuming this white line here is going to be the number of housing units, which has actually modestly increased. So to their point, they're saying any scarcity is not the result of population growth. It's actually the result of what they call rentier investors buying units as investments and holding them off of the long-term rental and ownership markets. So in other words, they're buying these properties and they're just leaving them vacant because they don't want to deal with the tenants. They just want the appreciation over the market, and they have the ability to service that property without needing to put a tenant in there. There's also a demographic component to this as well. The number of young people who can actually afford to buy a home from the absentee rentier wealthy, as they call it here, that number has actually diminished as interest rates have risen and housing prices have soared. Of course, we've talked about this many times. We have a major affordability issue right now in many of these markets across the United States. And one demographic that it's really hitting hard is going to be the millennials because, at least relatively speaking, they have a little bit less income, they have higher debt loads, certainly higher student loans, and then the cost of housing is substantially higher right now. It's making it very difficult for them to get involved in the market. So they're basically saying that this trend, in effect, is pulling liquidity out of the market because the wealthy can only sell to other wealthy households. But since that's only 5% of the population at best, the market is thin and illiquid, and it seems to be getting worse. And then one point that they drive home in this article is that housing demand is elastic. People, instead of purchasing or renting a very expensive apartment, they're going to move back home. They're going to move in with their adult children. They're going to take on a roommate because there's no law that says that the increasing population automatically guarantees that the populace can afford a $2,500 rent for a tiny apartment or a $750,000 purchase on a home that is falling apart. If in fact affordability gets worse, it's going to sideline more potential home buyers. And even though we have a low supply, demand can drop faster than the supply that we actually do have. Now, here's some of the risk that we're starting to see unfold here in the market today. They mentioned that in a recession, rents drop. We are not in a recession today, but it's possible that in the near future we will be. And they're saying it's possible that rental rates actually will go down because housing demand slackens and vacancies increase, putting pressure on rents to become lower. Once rents drop, valuations follow, and as valuations eventually reconnect with the fundamentals of income generated by the asset. And once the prices of homes start dropping, owners can no longer count on appreciation. And then suddenly a low risk asset acquires a different risk profile. It's losing value, not gaining value. Now, this chart right here I thought was really interesting. It shows the rise and fall of what they're referring to as the different housing bubbles. And so the blue line is referencing 2006 leading up to the great financial crisis. This long blue line here is from 1991 to 2006. That was the bull market in real estate here. And then you can see that the decline from peak to trough was from 2006 to 2012. And so that meteoric rise that we saw happened in just about equal proportion to about a 50% decline in housing prices over that 6-year span. And then right here, we're showing from 2012 to 2022. So we have a decade which had a massive increase in value. And their point here is that they're saying that housing prices are starting to fall beginning of 2022, and the indications that we have a long ways to go from here if we do it in equal proportion to this rise. You could argue that prices will stay flat and go up. You could argue that they'll continue to go down. I think you could probably make a case on either way, but the fact is that even though different segments of the market are getting impacted differently, at the moment, right now, we are starting to see home prices fall year over year. The reason I say that is because right now, like mid-tier luxury markets are getting hit a lot harder than, let's say, the entry-level or first-time buyer starter home. So what happens next from here? In this article, they refer to something called bubble symmetry, which basically means that the valuations have to fall at the same rate at which they rose, declining back to the starting point over roughly the equivalent time duration. And now we all know that the housing prices ran up massively here over the last few years alone. I mean, we've been in a bull market for at least 10 years at this point, which you can see by this chart, and we're just starting to see housing prices come down. There's a lot of moving parts here as to whether or not this decline here could potentially mirror this meteoric rise. We'll have to pay attention to it and see how everything plays out. But what do you think is possible? Do you think home prices are going to fall? Do you think each segment of the market will be impacted differently? What are some of the variables? But I thought this was a well-written article that made some really interesting points. I could certainly see an environment where housing prices maybe reverted back to roughly where they were pre-pandemic, maybe sometime in 2018, 2019, because a lot of this huge rise that we saw from, let's say, this point to right here was fueled by extremely low interest rates. And of course, right now, rates are back up even higher than they were pre-pandemic. Anyway, that is going to wrap it up for today's video. If you enjoyed the content, please hit that like button. Consider subscribing for more weekly housing market content, and we'll see you on the next video. Take care.